Regression analysis. Regression analysis is a way of measuring the relationship between two or more sets of data. A stock analyst might want to know the relationship between the price of gold per ounce and the share price of Barrick Gold Corporation ABX. An economist might want to know how the more complex relationship between interest rates, inflation, and the trade balances changes the value of the US dollar. A hedger or arbitrator could use the relationship to establish the relative fair value of two related products such as palm oil and soybean oil in order to select the cheaper product or to profit from price distortions. An investor might simply want to find the strongest stock in the banking sector, or you may simply want to find the best straight line fit through a series of prices. Regression analysis involves statistical measurements to determine the type of relationship that exists between the data studied. Many of the concepts are important in technical analysis and should be understood by all technicians, even if they are not used frequently. The techniques may also be used to trade as is shown at the end of this chapter. Components of a time series. Regression analysis is a tool often applied to identify the main component of a time series, the trend. With some variation, it can also be used to isolate the seasonal or secular trends and circular components. These three factors are presented in all price data. The part of the data that cannot be explained by these three elements is considered random or unaccountable price movement. Trends are the basis of many trading systems. Long-term trends can be related to economic factors such as changing interest rates, inflation shifts in the value of the US dollar due to the balance of trade, and even consumer confidence. The reasons for the existence of short-term trends are not always clear. Expectations of a merger or government approval of a new drug, a temporal disruption in oil supply, or a dock workers slowdown could all be catalysts for higher prices. However, trends that survive for only a few days or weeks cannot be explained by macroeconomic factors but are usually the results of investor behavior, reaction to the constant flow of minor news and market reports. Major sustained fluctuations above and below the long-term trend are attributed to cycles. Both the business and the industrial cycles respond slowly to changes in the supply and demand. And the decisions to close factories to build more container ships or office buildings is not made immediately, nor can the decisions be easily changed once it has been made. Stimulating economic growth by lowering interest rates is not a cure that works overnight. Opening a new mine, finding new crude oil deposits, or building an automobile assembly plant in another country makes the responses to increase the demand slower than the act of cutting back on production. Moreover, once the investment has been made, business is not inclined to stop productions even at marginal returns. Seasonality, the third component of price movement, is a form of cycle that depends on the calendar year. Most directly affected are crops, which are planting and harvesting cycles attributed directly to Mother Nature. The travel industry is much more active in the summer than winter, and there is a much higher demand for electricity in the summer. Oil refiners shift their refining from heating oils to gasoline in February and March as winter demand comes to an end, then change back again in the late summer. The fashion industry anticipates the change seasons in order to introduce their new lines of clothing. The random element of price movement is a composite of everything unexplainable. In later sections, an autoregressive integrated the moving average ARIMA or a box Jenkins methods will be used to find shorter trends and cycles that may exist in the leftover data. This chapter concentrates on trend identification using the methods of regression analysis. Seasonality and cycles are discussed in chapters 8 and 9 because the basis of a strong trading strategy is its foundation in real phenomena. Traders and serious students of price movement should understand the tools of regression analysis to avoid incorporating erroneous relationships into their strategies. A sound premise is the basis for success. Characteristics of the price data. A time series is not just a series of numbers but ordered pairs of price and time. There is a special relationship in the way price moves over various time intervals, the way price reacts to periodic reports, and the way prices fluctuate due to the time of year. Most trading strategies use one price per day, usually the closing price, although some methods average the high, low, and the closing prices. Economic analysis operates on weekly or monthly average data, but might use a single price, for example, week on Friday, for convenience. Two reasons for the infrequent data, also called low frequency data, are the availability of most major statistics, such as earnings, consumer confidence, or supply and demand, and the intrinsic long-term perspective of the analysis. The use of less frequent data causes a smoothing effect. The highest and lowest prices will usually not appear on the last day of a month or in average monthly data, and the data will seem less volatile. Even when using daily closing price data, the intraday highs and lows have been eliminated, and the closing prices show less erratic movement. Selection of the calculation period. A regression analysis which can identify price direction over a specific time period will not be influenced by cyclic patterns or short-term trends that are the same length as the time interval used in the analysis. For example, if we use 12 months of data, then the average of those 12 months includes an entire season of price changes. If the pattern was a perfect cycle, increasing by 15% during high demand and dropping by 15% during harvest or high supply, then the average would neutralize both up and down swings. Therefore, the use of calculation periods is equal to multiples of a calendar year is used for deseasonalizing the data. In figure 6.1, a regression line is calculated using the cash corn prices for the past 30 years. Although it is generally influenced by the exceptional rally in 2008, the center line increased from $2.36 per BU to $2.88 over the 30 years, or 0.73% per year. We can think of that as the inflation rate for corn, which is based on real inflation, the value of the US dollar, improvements in technology that increases the crop size, consumption, and other factors. The 12-month moving average is also plotted in figure 6.1. This is also not influenced by the seasonal price changes, but when prices rise over more than 1 year, an upward trend can be seen. If you do not want to remove the effects of seasonality or longer cycles, the time interval of the regression analysis should be 3 months or less. In this way, a regression analysis or any trend technique may be used to identify a seasonal or cyclic element. In classical time series decomposition, the trend is removed first, and the trended series is then used to find the cyclic and the seasonal components. This can be done by 1. Subtracting the daily prices from the corresponding daily value of the regression line, or taking the first difference as pt minus pt minus 1 for the entire data series. Linear regression. When most people talk about the regression, they normally think about drawing a straight line through the center of some period of price movement, such as in figure 6.1. At the end of this chapter, and in the discussion and the comparisons of trend systems, we will use the slope of the linear regression applied to a single price series to create the trend trading method. But regression is a simple and powerful tool for explaining the relationship between two price series. In econometrics, analysts use multiple regression to find the relationship between various factors such as supply, demand, inflation, and price. In this chapter, we look at how regression can be used as a trading tool for a single market to find the relationship between the two markets or two data series to rank markets. The inputs to a regression analysis must be two time series of the same frequency, most often daily, weekly, or monthly. For trading, we will use daily data, but for an economic relationship, monthly is better. We start with the linear relationship between the two price series x and y. A linear relationship will try to find the value of y, the dependent variable, for each variable of x, the independent variable, using the formula for a straight line, that is y equals to a plus bx, where a is the y-intercept of the line, and b is the slope, the point where the line crosses the y-axis when the value of x is 0. The linear regression is also called a straight line fit, or simply the best fit. It selects the straight line that comes closest to most of the data points. The results tells you that, or for example, for every move of $1 in a series X, we can expect a move of $1.5 in a series Y, or we can expect that inflation to increase the price of corn by 0.00029% per day. We will apply a linear regression in two examples. First, to explain the price movement of corn based on the price of soybeans, then to explain the price of Barrick Gold Corporation, ABX, based on the price of physical gold. Explaining, not predicting. You may have noticed that we were to explaining the Barrick Gold stock price in terms of the price of gold bullion. We do not say that we can predict the prices. We are finding the past relationship between two prices series. You may decide that the relationship can be used to trade those two markets whenever prices move too far from one another. The regression analysis may establish what you see as a fair value for one market based on the price of the other. In order to forecast a price, you will need to establish that conditions at the date of your forecast are likely to be the same as the period over which the regression was calculated. You must also account for the loss of accuracies or confidences as you forecast further into the future. Calculating the best straight line fit. The simplest examples of linear regression, called the method of least squares, is the one used most often by traders in the one seen in figure 6.1, calculating the best straight line fit through a selected period of price movement. This is done in the same way as finding the relationship between two price series, except that we will substitute the simple sequence 1, 2, 3, 4, and so on. For the second series, we do not use the date as the dependent variable because weekends and holidays break the continuity of the series. We choose 10 days of price movement in Walmart during March 2002. In order to find the best straight line fit, we begin with the equation for a straight line y equals to a plus bx. In this equation, y is the dependent variable because it is a function of the value of x, the independent variable. The slope b is the relative change in y for every unit change in y. Therefore, if b equals to 0.20 and x are sequential days, then for every day the price y gains $0.2. The y-intercept of x is an adjustment in the price level to bring x and y into alignment. It is also the point at which the straight line crosses the y-axis when x equals to 0. Method of least square. The method of least square finds the straight lines that comes closest to all prices. To do this, calculate the sum of the squares of all the differences between the price and the corresponding value of the straight line and choose the line that has the smallest total deviation. The mathematical expressions for this is s equals to the sigma summing for all I starting from t minus n plus 1 to t of the value, the square of yi minus yi hat. and where S is the sum of the squares of the error at each of the 10 Walmart points on the straight line, 1 point for each price designated by I equals to 1, 2, 3, and so on, and Y equals to the price of Walmart on day I. Y hat equals to the estimated values of this price on the straight line, and also yi minus yi hat is the difference between the actual price yi at I and the predicted value yi hat. Graphically, the individual deviations or errors for the first 4 points may look like those in figure 6.2. Each actual data point is 1, y1, 2, y2, 3, y3, and so on, and the corresponding positions on the regression line is 1 y1 hat, 1 y2 hat, 1 y3 hat. The sum of the squares of the error is as follows. S equals to the sigma of with index I starting from t minus n plus 1 until t of the square of y minus y hat. If we expanded the terms within this sigma summations, then it would be equals to y minus y hat squared plus y1 minus y1 hat squared plus y2 minus y2 hat squared plus y3 minus y3 hat squared plus y4 minus y4 hat, then to the square. The straight line that causes S to be the smallest possible value will be the best choices for these data points. The square of ya minus ya hat is always positive, therefore prices above and below the regression line are treated equally. To use the least squares methods for solving the Walmart time price relationship, looking for the solution to the straight line y equals to a plus bx and express as follows. That b is equals to n times sigma summing for all xy minus sigma x times sigma y, then divided by the following term in the denominator, that is n times the sigma of x squared minus the square of the sigma of x, and a is equals to 1 divided by n times the following term, sigma y minus b times sigma x. So to calculate the a, we have to calculate the b first, where n is the number of data points, 10 in the Walmart example, and the sigma is the sum over n points. Now, in order to solve these equations, use a spreadsheet and enter the Walmart prices in a column B, see table 6.1. Construct a table where all of the individual expressions in the two formula can be calculated, see table 6.1. We can now substitute the values on the sums line into the two equations. That is b equals to 10 times 2776.98 minus 55 times 494.30 divided by 10 times 385 minus 55 squared. That is equals to 27,769.8 minus 27,186.5 divided by 3,850 minus 3,025, which is equals to 0.70703, and a is equals to 1 over 10 times 494.3 minus 70,703 times 55. That will be equals to 455.413 divided by 10, that is 45.5413. And the equation for the least square approximation is y equals to 45.5413 plus 0.70703x. Selecting values for x and solving for y gives the result shown in the right column of table 6.1 representing the straight line feet. This is shown along with the original prices for Walmart in figure 6.3. The straight line approximation increased by 0.707 cents per day, and the approximation line starts at 45.54, where x is equals to 0. Now, Excel regression. Excel makes this much easier, although the formulas given above are easily programmed directly if you are not using Excel. Excel's regression function can be found in the drop-down value menu data/data analysis. This is available as an add-in if you are not already loaded, then regression. Selected the sequential values as x, the price as y, and the output at any cell to the right of the data. Excel will produce the analysis shown in Table 6.2. The y-intercept and the slope that can be found in the bottom left to the table. Also of interest is the correlation, r equals to 0.92 at the top, which shows the quality of the feed, which is very good. Corn explained by soybeans. Finding the relationship between corn and soybean prices will tell the farmer whether planting one or the other is a better business decision. We used the same technique, but this time we used the corn and soybean price series instead of letting one of the simple integer sequence. Table 6.3 gives the cash prices and the intermediate calculations. These results in the slope 0.282 and the y-intercept equals to 0.336, giving the equation for the regression as y equals to 0.282 plus 0.336x. The Excel solution is shown in table 6.4 with the declaration r equals to 0.91. Looking at the scatter diagram of the corn-soybean relationship figure 6.3, we see that if corn is selling at $2 per BU, we can expect that the soybeans is to sell at $5 per BU. This is just what would be expected for farm income, because the corn yield per acre is 2.5 times greater than the soybean yields in most parts of the United States. The ratio 1 against the 2.5 will yield $5 for soybeans when corn is $2. Gold bullion and the Barrick Gold Corporation. A question often asked is if a gold goes up by $1, how much will a gold mining share go up? For this to make sense, the mining companies should not be diversified but concentrated on gold production. To find out how the stock price of Barrick Gold Corporation can be explained by the price of physical gold, we will look only at the 6 months following the tragedy of September 11th in 2001. If you have reviewed the method of solving the corn-soybean relationship, you will understand how to interpret the results of the spreadsheet solution. First, prepare the data for the Excel solution. We import the price of ABX and the gold into a worksheet and align the dates. Fill data forward for any missing dates. Next, index each of the price series, beginning with 100. This step is not essential for the solution, but it will be necessary when comparing markets for ranking. A later section in this chapter, and to get the results in the percentages in this section, the relationship will be solved both with the original data and with the indexed data. Each index value is IT equals to IT minus 1 times PT divided by PT minus 1, where PT is today's price. See chapter 2. The two index series now are in the same percentage notation as seen in table 6.5. Using the Excel regression function applied to the row prices, the slope is 0.060 and the y-intercept is minus 0.418. This means that for every $1 increase in gold, ABX will increase by 6 cents. Using the indexed values, the slope is 1.012 and the y-intercept is minus 2.586. For every 1% increase in gold, ABX increases by 1.012%, showing that there is essentially a 1-to-1 relationship between gold and ABX in this very short example. To calculate the estimated value from the indexed results, the formula is ABXT equals to 1.012 times gold T minus 2.586. The estimated value of ABX is shown for both the actual prices and the indexed prices in figure 6.4a and b. In both cases, the estimated price of ABX tracks gold very closely, yet offering an interesting trading opportunity for arbitraging gold and ABX when they move apart. This will be discussed in chapter 13. Programming and the spreadsheet tools. In addition to the regression function Excel data analysis, there are simple functions that can produce the same results. Slope of yx returns the slope value b when you enter the column lists for y and x. Intercept of yx returns the y-intercept a when you enter the same value for y and x. Once you know what to look for, it becomes easy. In the strategy development software, such as TradeStation, the functions that calculate the linear regression are nearly the same. Linear reg slope or linear reg angle, linear reg value, linear reg intercept all produce the estimated values using the dependent variable. Most often, traders are only interested in the slope as a way to identify the direction of prices. Using daily data, they add the slope value to the most recent price to project tomorrow's price. Projected price of 1 day ahead equals to today's price plus slope. If they wanted to project n days ahead, they multiply the slope by n. Projected the price of n days ahead equals to the price plus n times the slope. As prices are projected further ahead, there is a much greater chance of error. This is discussed in a later section. Confidence bands. Linear correlation, solving the least squares equation for the best fit, does not mean that the answer is useful. In the previous sections, we used the price series that had a clear relationship, therefore, the results appeared valid. The least squares methods will always give an answer, even when there is nothing that makes one price series dependent upon the other. You may think that two data items affect one another, such as the amount or disposable income and the purchase of television sets, but that might not be the case. Instead, the purchase of a television set may peak just before the Super Bowl. The linear correlation, which produces a value called the coefficient of a determination. R squared, or the correlation coefficient, expresses the strength of the relationship between the data on a scale from +1, perfect correlation, to 0, no relationship. It may be even better to look at R, which varies from +1 to -1, rather than R squared, because you then know whether the correlation is positive or negative. A negative correlation between the two price series means that when one goes up, the other goes down. When R equals to +1, there is a perfect positive correlation. When R equals to 0, there is no correlation. And when R equals to -1, there is a perfect negative correlation, as shown in figure 6.5. This is the most practical way to find out whether two price series are moving in a similar manner. If R squared is less than about 0.20, then the linear regression has no practical value. In the examples that looked at the corn-soybean relationship, the Excel results showed an R squared equals to 0.83, very high, while the ABX gold correlation, whether using price or indexing, was only 0.26. For arbitrary purposes, however, it is more important to look at the co-integration rather than correlation, and this is covered in chapter 13. To calculate the correlation coefficient R for the most recent n days, where t is today, we use Pearson's product momentum correlation. R equals to 1 over n times the sigma, summing t I starting from t minus n plus 1 until t of the term, that is xi minus xi x bar divided by sx, and also yi minus y bar divided by sy. And in the preceding calculation, sx and sy in the denominator are the standard deviations of x and y, and x bar and y bar are the average. The result R is interpreted as follows. If R is equal to +1, then a perfect positive linear correlation. The data points are along a straight line going upwards to the right. We can see that from figure 6.58, for every upwards move in x, there is the corresponding upwards move in y. If R is greater than 0 but less than +1, then the scattered points become more uniformly distributed about a positive approximation lines. As the value of r becomes closer to plus 1, this is in figure 6.5b. If r equals to 0, then no linear correlation exists. This is from figures 6.5c and 6.5d. Now, if r is between minus 1 and 0, then the scattered points become more uniformly distributed about a negative approximation line as the value of r becomes closer to minus 1. If r equals to minus 1 and a perfect negative linear correlation, the line going downward to the right, figure 6.5e, for every upwards move in x, there is a corresponding downwards move in y. In Excel, the correlation function is the corel of xy, which returns r squared. The formula appears to be different, but it is only a regrouping of the factors. If you need to know if the correlation is positive or negative, it will be necessary to do the calculation yourself. But in the spreadsheet TSM ABX Gold regression comparison of power fits compares the formula given above with the Excel method. Now, correlation adjustments is when using a time series. Because most price analysis involve the use of two time series, precautions should be taken to avoid a trend that can distort the results. A long-term upward or downward trend will overshadow the smaller movements around the trend and exaggerate the correlation. Inputs to correlations are typically price changes, not the actual prices. It is best if these changes are in percent. But for back-adjusted futures data, the price differences should be used. Most software, such as Excel, will calculate the correlation on whatever series you input. So it is your responsibility to detrend it first. Forecasting using regression. A distinct advantage of regression analysis is that it allows the analyst to forecast the price movement. In the case of linear regression, the forecast is simply an extension of the straight lines. If you consider that the regression values give the mean over the calculation period, then the forecast is an extension of the mean, which, if you have no other compelling information, is always the safest forecast. Later in this chapter, there will be other nonlinear solutions that are used to predict the more complex patterns. Regression forecast is the basis for the probabilistic model. Instead of the corn-soybean relationship, find the slope and the y-intercept of a straight line fit using the price of soybeans and the sequential time as we did in the first Walmart example, table 6.2. The result is y equals to 0.987 plus 0.221x, where y is equal to the price of soybeans for the year x. Because the solution substituted the value of 1 for 1,956 and 27 for 1,982. 1,982. The average farm income per bushel of soybeans is as forecast as 7.32 in 1985, x equals 30, and 8.38 in 1990, x equals 35, increasing 22 cents per year. That would put the price of soybeans at $13 in 2011, where it's now trading at slightly over $14. Confidence bands. Regression analysis includes its own measure of accuracy called the confidence level. It is based on the probability distributions of the errors in the fitted equation in the size of the data sample. Looking at figure 6.3, the straight line cannot touch all the points, but its goodness of fit may be measured by using the standard deviation of the errors to determine the variance over the total number of data points, and the errors E are the difference between the actual data points and the corresponding point on the least squares line. If the actual data points are yi and their corresponding value on the fitted line yi hat, Then S is the standard deviations of the arrows. S equals to the square root of the sigma of E squared divided by N, where each I is equals to I minus Y hat. Referring to the table of a normal distribution, Appendix 1, the 95% level is equivalent to 1.96 standard deviations. Then a confidence band of 95% placed around the forecast line is written as 95% upper band equals to 1i plus 1.96 sigma, and 95% lower band is equals to 1i minus 1.96 sigma. Now, figure 6.68 shows the soybean forecast with a 95% confidence band. The points that are outside of the bands are of a particular interest and can be interpreted in one of two ways. One, they are not representative of normal price behavior and are expected to correct the levels within the bands. Two, the model was not performed on representative or adequate data and should be re-estimated. Figure 6.6b also indicates that the forecast loses accuracy as it is further projected. The forecast is based on the size of the sample used to find the regression coefficients. The more data included in the original solution, the longer the forecast will maintain its accuracy. In the previous examples of the corn-soybean relationship, the Excel analysis output table 6.4 showed the values corresponding to the 95% confidence level for both the slope and gamma-intercept and y-intercept. Generally, the slope is the more interesting value. The solutions for the slope was 0.3358 with the upper 95% at 0.3974 and the lower 95% at 0.2742, 18% higher and 22% lower respectively. These values are large because only a few data points were used. Now, linear approximations for two variables. The linear regression a plus bx, also called a first-order polynomial equation, is the simplest way of finding the relationship between two price zeros. It uses one multiplier, the slope of power 1, hence first order, and one constant, the y-intercept, to shift the starting point. By adding the third term, c times x squared, the approximation can be made much more accurate when a factor, such as the decline in the supply of gold, would cause the stock prices to rise at a faster rate. The third term, x squared, introduces a parabolic curve, a single smooth change of direction. The fourth term, d times x to the cube, would add inflection, the ability for the curve to turn up and down at different points. Each time we add one more term, the ability to fit one price series based on another becomes better, because we will want to create a polynomial with more than 2 or 3 terms. It is more convenient to change the general notation to y equals to a0 plus a1x plus a2x squared and so on plus e in x to the n. The first two terms on the right side of the equal sign form the equation of a straight line where a0 was coded a and a1 was coded b. For most price forecasting, the second order equation, also called the curvilinear, which uses 3 terms, is sufficient. Figure 6.7 shows the general form of a second order equation curving up and to the right at the increasing rate. If we want to know if the price of ABXs will go up faster than the linear approximation when gold prices move much higher, then we will want to try a second and third order approximation. Instead of a period of only a few days, the solution will use 10 years from 1998. A spreadsheet with this data and the results of the approximation TSM ABX gold regression is available on our website. The second order curvilinear form is y equals to a plus bx plus c times x squared. Must be solved for the coefficients a, b, and c using the simultaneous equations. That is n times a0 plus a1 times sigma of x plus a2 times sigma of x squared equals to the sigma of y, and a0 times sigma of x plus a1 times sigma of x squared plus a2 times sigma of x to the cube is equal to sigma of xy. A0 times sigma of x squared plus A1 times sigma of x to the cube plus A2 times sigma of x to the fourth is equal to sigma of x squared times y. Now, second order least square solution. The least square solution can be extended to the curvilinear second order equation by minimizing the sum of the errors. S equals to sigma I starting from 1 to n of the term, the square of y minus a0 minus a1 xi minus a2 xi squared. First, it is necessary to separate the various intermediate sums before expressing the solution for a0, a1, and a2. As xx equals to 1 over n times sigma of summing for all I starting from 1 to n of the square root of xi minus x bar, and sxy is equals to 1 over n times the sigma summing for all I starting from 1 to n of xi minus x bar times y minus y bar. And also syy equals to 1 over n times the sigma summing for all in xi starting from 1 to n of the square of yi minus y bar. Again, as xx squared is equals to 1 over n times the sigma summing for all index I starting from 1 to n of the term xi minus x bar times xi squared minus x bar squared. As x squared is equals to 1 over n times sigma for I starting from 1 to n of the square of the term xi squared minus x bar to the square. Note, this is the difference between the two squares then to the square. Now, as yx squared is equal to 1 over n times sigma summing for index I starting from 1 to n of yi minus y bar times xi squared minus x bar squared. The constant value can then be found by substitution into the following equations. That is, a1 equals to sxy times sx squared minus syx squared times xx squared divided by sxx times sx squared minus the square of sxx squared. And also a2 equals to sxx times syx squared minus sxx squared times sxy divided by sxx times sx squared minus the square of sxx squared. And a0 is equals to y bar minus a1 x bar minus a2 x bar squared. The procedure is identical to the linear least squares solution. Unfortunately, there are simple computer programs that have already been written to solve these problems, such as Polysophilus OpenLab. Alternatively, Excel can be used if the inputs are transformed. ABX code results. The calculations from table 6.3, including the additional sums for x to the cube, x to the fourth, and x squared times y, can be substituted into the preceding equations. For the general solution, the system of simultaneous linear equations can be solved by the process of matrix elimination, a technique that should not be performed without the help of a computer. However, for those foolish enough to try, an example can be found in the appendix. For this solution, we'll use the Brostat software which imports the data, ask for the independent and dependent variables. Then the order 2, 3, 4 then gives a solution which is summarized in table 6.6. For a fully programmable integrated platform, MATLAB is the preferred choice. Figure 6.8 and 6.9 give a visual interpretation of the ABX gold relationship. Figure 6.8 overlays the gold and the ABX prices on the same chart with the ABX prices scale on the right and cash gold on the left. For the first 8 years from 1998 through 2006, prices tracked each other very closely. It was only as volatility became extreme during the most recent years that the pattern varied, mostly in different volatility than in actual direction. The results of the linear second order and the third order solutions are shown in figure 6.9. The linear and the third order solutions track the price of ABX very closely, up until volatility increases in the late 2006. The pattern is right, but the forecasted ABX prices are much less volatile, which is understandable given that more data exists with low volatility. If prices return to pre-2006 volatility levels, the fit should again be good. It is interesting that the second order solution had a better volatility fit, but forecasted the prices to be much higher given higher volatility. A simple calculation of the variances of the forecast from the actual price would show which solution is best. Transforming nonlinear to linear. Two curves that are often used to forecast prices are logarithmic, power, and exponential. See figure 6.10. The exponential curving up is used to scale price data that become more volatile at higher levels. The curve that bends down, where b is between 0 and 1 in figure 6.10a, is typical of volatility measured over increasing time intervals. Each of these forms can be easily transformed into linear relationships and solved using the method of least squares. This will allow you to fool the computer into solving a nonlinear problem using a linear regression tool. To solve the logarithmic relationship, substitute ln x for x, ln a for a, and ln y for y. Instead of using a column of x values as in, the spreadsheet create a new column that has the values in x, ln x. Create another column with ln y. Now solve the regression using ln x and ln y instead of x and y. When completed, you will have the value of b, but you will also have ln a instead of a. The value of ln a must be raised to the power of e to restore the original value of a. A equals to ln a to the e, the number e. The Excel function for the power of e is exp. Once you have the values a and b, the logarithmic approximation can be calculated and plotted. The significant differences in the log and the exponential transformations is that the value of x is not scaled for the exponential, taking the original corn and soybean data and performing the natural log functions. Ln for both log and exponential approximations results in the linear form that can be solved using least squares. Returning to the simpler corn-soybean example, select the results are shown in table 6.7. Evaluation of two variable techniques. Of the three curve-fitting techniques, the curvilinear and exponential results are very similar, both curving upwards and passing through the main cluster of data points at about the same incline. The log approximation curves downward after passing through the main group of data points at about the same place as the other approximations. To evaluate objectively whether any of the nonlinear methods are a better fit than the linear approximation, find the standard deviation of the errors, which gives a statistical measurement of how close the fitted line comes to the original data points. The results show that the curvilinear is best. The logarithmic, which curves downwards, is noticeably the worst. See figure 6.11. When we display system performance based on a fixed investment size, it is necessary to show the results on a log scale to be realistic. Otherwise, the investment must change each day based on the returns. Similarly, volatility looks more uniform over time when shown on a log scale. The use of regression analysis for forecasting the price of soybeans alone had a different conclusion. Although 27 years were used, the last 10 showed a noticeable increase in the soybean prices. This rising pattern is best fitted by the curvilinear and exponential models. However, these curves show price forecasts that continue to rise at an increasing rate. Had inflation maintained its double-digit rate, these forecasts would still lead to unrealistically high prices. The logarithmic model, which tends to flatten at the top, turned out to be the most realistic. This shows that the problem of forecasting is more complex than this naive solution. Common sense tells us that prices cannot continue to accelerate upwards. The logarithmic model, which showed the worst statistical results, provided the best forecast. The logarithmic model is similar to the square root technique that is commonly used to estimate volatility of longer time intervals using shorter interval data, as was shown in the section of Chapter 2 called the Risk and Volatility. To avoid using the wrong solution, most analysts carefully track the major economic factors such as interest rates, inflation, and the value of the US dollar. The model must be estimated whenever these factors change or wherever there is new data that may result in a more accurate solution. They may use a rolling calculation interval, dropping off the oldest data and adding the most recent. They may also use multivariate approximations discussed in the next section, which evaluated more than one independent or casual variables. Direct relationships. The price at which a commodity or stock trades is often dependent upon the prices of other competitive or substitute products. This can be seen for stocks where two pharmaceutical companies provide the same product, such as the cholesterol drugs Lipitor and Zocor, and for airlines vying for passengers on the same route. The ability to substitute one product for another creates an opportunity for arbitrage. In general, if two physical products provide the same function, they should sell at the same price, net of transaction costs, which can include carrying charges, shipping, inspection, and commissions. These relationships are watched carefully when they move apart by more than the transaction costs. Traders step in quickly to buy the cheaper one and sell short at the more expensive one, causing prices to come back into alignment. In the equities markets, this is the basis for pairs trading. In the commodities, arbitrages keep the futures and cash prices together. They continually prevent the price of gold in New York, London, and Hong Kong from drifting apart. For interesting rate market strips serve the purpose of preventing the large pool of 3-month rates, 5 and 10 years notes, and 30-year bonds from offering wildly different returns when they revert to the same maturity. The interbank market provides the same stability for foreign exchange markets, and the soybean crush, energy crack, and other processing margins do not stay out of line for long. Competition will keep the prices of Lipitor and Zocor together, and the addition of a generic substitute will cause all three to realign. The following, the non-financial markets have closer relationships that can be found using regression analysis. Okay, this is the list of a commodity product relationship and reason. For all crops, the reason is income for farmers based on per acre yields. For grains, is that reason is protein value used for feed. For livestock and feed grains, the reason is cost of feed affects the cost of livestock. In the oil livestock, the reason is that the consumer purchases influences by price. And also for the sugar and corn, the reason is that the commercial sweetener substitution. Now, what is the hogs and the pork bellies? The reason is product dependency. Bacon prices depend on hog prices. Now, for silver, gold, and platinum, the reason is investors' inflation hedge. For the interest rates in the stock market, the reason is the investors continually choose between stocks and the interest rates. For the interest rates and foreign exchange, the reason is that investors worldwide move money to seek the best returns and protect against inflation. Multivariate approximations, regression, analysis is most often used in complex economic models to find the combination of two or more independent variables that best explain or forecast the prices. Simple applications of annual productions and the distribution of soybeans will determine whether these factors are significant in determining the price of soybeans. Because the demand for soybeans and its product is complex, we should not expect a very accurate model using only two independent variables. However, the method of solution is the same when you add other factors. The first example will use a small sample of data shown in table 6.8. At the end of the section, the same method will be applied to wheat using a much longer set of data. Applying the methods of least squares which was used for a simple linear regression, the equation for two independent variables is y equals to a0 plus a1 times x1 plus a2 times x2, where y is equals to the resulting price, in this case soybeans, and x1 equals to the total production supply, and x2 equals to the total distribution demand, and a0, a1, a2 are the constants or weighting factors to be calculated. As in the linear approximation, the solution to this problem will be found by minimizing the sum of the squares of the arrows at each point where y hat is the approximations for the ith data, yi hat is the approximation for the ith data item, and y is the actual price. So S is equals to sigma summing for all index I starting from 1 to n of the square of y minus yi hat. Substituting y hat from the previously equation, that is S equals to sigma summing for all I starting from 1 to n of the square of yi minus a0 plus a1x1 plus a2x2, then to the square. The solution to the multivariate problem of two independent variables x1, x2 requires the following three least squares equations. a0 times n plus a1 times sigma of x1 plus a2 times sigma of x2 equals to sigma of y. a0 times sigma of x1 plus a1 times sigma of x1 squared plus a2 times sigma of x1 x2 is equal to sigma of x1 y. a0 times sigma of x2 plus a1 times sigma of x1 x2 plus a2 times sigma of x2 squared is equal to sigma of x2 y. The procedure for solving the three simultaneous equations is the same as the curvilinear method of coefficient elimination. The sums are calculated in table 6.8, then substituted into the least three equations. 12 times a0 plus 13.54 times a1 plus 12.58 times a2 equals to 44.4. 13.55 times a0 plus 15.98 times a1 plus 14.75 times a2 equals to 53.28. 12.58 times a0 plus 14.756 times a1 plus 13.86 times a2 equals to 49.264. Now the coefficient metric solution for the previously formula is the following. 4 different 3 by 4 matrices. The first one is 12, 13.55, 12.58, 44.4, 13.55, 15.98, 14.74, 53.28, 12.58, 14.74, 13.86, 49.26. The second one is 1, 1.239, 1.048, 3.7, 0.67898, .5451, 3.145, 0.5451, .6720, 2.714. The third one, the third matrix is as follows: 1, 0.1429 minus 1.5240, 0, 1.A018, 4.6264, 0, 0, .2349, .1922. The fourth one, the fourth matrix is as follows: 1, 0, 0, minus 1.641, 0, 1, 0, 3.9703, 0, 0, 1.8183. Now the results show a0 equals to minus 1.641, a1 equals to 3.9703, and a2 equals to .8183, so that the multiple linear approximation of the price is y hat equals to minus 1.641 plus 3.9703x1 plus 0.8183x2, where x1 is the production of soybeans in a billions, of bushels, and x2 is the demand in the billions of bushels. The coefficient of supply is much larger than the coefficient of demand. Therefore, it is the principal factors in the determination of price. Had either coefficient of x1 or x2 been small, it would have indicated a lack of significance. The selection of which data to use when determining price components is not always obvious and may result in a number of small coefficients. In this example, supply and demand figures were used to determine price, but perhaps supply and inflation or demand and inflation would have been better. Further, this method will always give an answer even when the choice of data is erroneous. To find out which sets of data are best, each combination would have to be tested, and the variance of the estimated values is compared with the actual prices. The best fit and the best choice should be the one with the smallest variance, provided you have used sensible inputs. As with the least squares and polynomial solutions, user-friendly software as well as fully programmable platforms are available. This makes solutions available to everyone. If we look at a longer set of data for wheat, available from the Commodity Research Bureau yearbook, published annually by John Wiley and Sons, we can take the supply as world production and calculate the demand by subtracting the ending stocks from the production, given us usage. Finally, the cash price in Chicago is selected as the value to be forecast. The data was available from 1971 to 2000, but only the first few years are shown in Table 6.9. The full spreadsheet and the forecast results are available on our website. Solutions to the equation cash price I equals to A0 plus A1 times production plus A2 times usage gives A0 equals to 0.2909226, A1 equals to minus 0.01399, and A2 equals to 0.028385. A chart of the forecast values is compared to the actual cash prices is shown in figure 6.12. The forecast is reasonably close to the cash prices, moving in the same direction most years, but with a generally lower volatility. Perhaps a better estimate of world demand rather than relying on the final US stocks would make this more accurate. Then an estimate of supply and demand would result in a reasonably good estimate of the price. Recently, neural networks and genetic algorithms have been used to find solutions to complex problems of supply and demand. Both have the advantage of providing a nonlinear solution. That is, the multivariate answer to the soybean problem says that the effect of supply is always 4 times greater than the effect of demand. But the neural net solution may qualify that answer by giving a larger weight to supply during years when supply is threatened by bad weather. Both the genetic algorithms and the neural nets are discussed in Chapter 20. Selecting data for an S&P model, the stock market is driven by a healthy economy and lower interest rates. A good economy means that there is high employment and consumers are actively buying homes, durable goods, services, and frivolous items with their disposable income. Low interest rates increase corporate profitability by reducing the cost of debt and provide lower mortgages for homeowners. Economic growth and controlled inflation are delicately orchestrated by the central bank of each country. In the United States, it is the Federal Reserve. Now to create a robust S&P model, one that explains the change in S&P prices using economic data, it is necessary to select the most meaningful data. The following was suggested by Lincoln to be used for a 6-month S&P forecast. S&P price, the closing prices of the Standard & Poor's S&P 500 cash index. Corporate bonds / treasury bonds. The BA corporate bond yield divided by the 30-year treasury bond yield, normalized by subtracting the historical mean. Annual change in the US dollar, the 12-month change in the dollar -1, which might be based on the dollar index traded on the New York Futures Exchange discussed in Chapter 2, or a weighting of major currencies. Annual change in the federal funds rate, the 12-month change in the Fed funds rate -1. Federal funds rate slash discount rate, the Fed funds rate divided by the discount rate, normalized by subtracting the historical mean. Money supply M1 money supply not seasonally adjusted. Annual consumer price index, the 12-month change in the CPI minus 1. Inflation slash disinflation index, the annualized 1-month change in the CPI divided by the 12-month change in the CPI minus 1. Leading economic indicators, the 12-month change in the leading economic indicators minus 1. 1 month versus 10 months oscillators for the S&P cash index, the differences between the monthly average and the past 10 months approximately 200 days. Inflation adjusted commercial loans, the inflation adjusted 12-month growth in the commercial loans. Lincoln used 20 years of monthly values to forecast the S&P price 6 months ahead. Some of this data is available on a weekly basis and might be adapted to a shorter time frame. However, it is reasonable to think that an accurate daily forecast is possible using weekly or monthly data. It is also likely that the use of more frequent S&P price data is inconsistent with the monthly statistics and will introduce more noise and make the results less reliable. One element that is missing from the 11 items listed is a volatility adjustment. There has been a 600% increase in the S&P price over 20 years, and volatility is clearly much higher. A simple percentage relationship may not describe this change adequately, but may be used until a better one is found. Therefore, those items that become more or less volatile as prices move higher and lower must be corrected using a volatility normalizing factor. For example, if we consider the initial volatility when the S&P was 100 at the beginning of the data as normal, then when the price is 1400, we divided the current volatility by 14 to normalize or use some volatility stabilization adjustment. This type of adjustment would apply to nearly all the items except the money supply. And the inflation slash disinflation index. Remember that where applicable, yields must always be used for interest rates, not price. Generalized multivariate solution. In general, the relationship between n independent variables is expressed as follows: y equals to a0 plus a1 x1 plus a2 x2 and so on to plus an xn. The solutions to this equation is the natural extensions of the problems in 2 and 3 variables. The n plus 1 equations in n plus 1 variables are created by summing the n plus 1 equations developed for the general equation by multiplying the second equation by x1, the third by x2, and so on. So that is a0 times n plus a1 times sigma of x1 plus a2 times sigma of x2, and so on, plus an times sigma of xn equals to sigma of y. A0 times sigma of x1 plus a1 times sigma of x1 squared plus a2 times sigma of x1 x2 and so on, plus an times sigma of x1 xn is equals to sigma of x1 y. A0 times sigma of x2 plus a1 times sigma of x1 x2 plus a2 times sigma of x2 squared plus and so on, plus an times sigma of x2 Sn is equals to the sigma of x2y. This is the third line of the formula. And so on, we have n lines. So the n line is a0 times sigma of the nth line is a0 times sigma of xn plus a1 times sigma of x1 times xn plus a2 times sigma of x2 times xn and so on, plus an times sigma of xn squared, which is equal to sigma of xn times y. It is not practical to solve the system of equations manually, but it can be done quickly using a single program found in a math software library such as IMSL, Prostate, MATLAB, and even using Excel matrix functions. See a more detailed example in Appendix 2. Those with only a little experiences in regression analysis should remember that the model is most accurate within the range of the data points. When projecting outside the bounds of the sample data, the predictive qualities of the regression formula decrease with time. It is most likely that a good solution will be found for interest rates and gram prices, which are trading at the same levels as previous years, but may not be reliable for index markets or gold that have made erratic new highs over the years. Many dependent variables, xi, may be used to increase the possibility of finding a good fit. The predictive quality of the solution will depend on the relevance of the independent variables, it is best to start with the obvious components of a time series, such as inflation, then add standard economic statistics, including a consumer price index and the industrial product, as well as supply and demand information specific to the market being evaluated for both grain and energy markets. The accumulation of inventory or stocks is a strong influence on price. These factors also have an expected seasonal variation, which is represented in terms of an index of adjustment. Using monthly data means that you must have a strong tolerance for risk because even the best models do not account for the price fluctuations during the month. Measuring the error of the estimates will help determine whether additional factors are necessary. When done, look at the values of A. Those that are very small should be discarded. The fewer inputs are better, the better. Least squares sinusoidal. When you know that there is a seasonal or cyclic pattern to price movement, you can use the trigonometric functions sine and cosine as a special case of multiple linear equations. Observing periodic peaks and valleys in a price series suggests that a cyclic pattern may be present. One of the more well-known uses of cyclic analysis was performed by Hurst in the profit metric of stock transaction timing, in which there is an interesting example of a Fourier analysis applied to the Dow Jones Industrial Averages. A full discussion of cyclic analysis and trigonometric estimation can be found in Chapter 11. The equation for the approximations of a periodic movement is yt equals to a0 plus a1 times t plus a2 times cosine of 2 pi t divided by p plus a3 times sine of 2 pi t divided by p plus a4 times t times cosine of 2 pi t divided by p plus a5 times t times sine of 2 pi t divided by p, which is a special case of the generalized multivariate approximation, that is y equals to a0 plus a1x1 plus a2x2 plus a3x3 plus a4x4 plus a5x5, where p is the number of data points in each cycle, and x1 is equals to t, the increment time element, and x2 is equals to cosine of 2 pi t divided by p, a cyclic element, x3 is equals to sine of 2 pi t divided by p, a cyclic element, x4 is equals to t times cosine of 2 pi t divided by p, an amplitude variation element, and x5 is also an amplitude variation element, which is t times sine of 2 pi t over p. The number of data points p in each cycle would be 12 if you were calculating seasonality using monthly data. If you believe that there is a cycle, then you can find the average number of data points between major price peaks. The term A1t will allow for the linear tendencies of the sequence. The term 2 pi refers to an entire cycle, and 2 pi t over p is a section. 1 over p of a specific cycle t. This in turn adds weight to either the sine or cosine functions at different points within a cycle. The solution is calculated in the tabular manner of the other methods using simultaneous linear equations derived in the same way as the generalized multivariate equation. Substituting from the table of sums and solving the coefficient matrix of A0, A1, A2 until A5 using the techniques in Appendix 2. ARIMA ARIMA. An autoregression integrated moving average ARIMA model is created by a process of repeated regression analysis over a moving time window, resulting in a forecast value based on the new fit. An ARIMA process automatically applies the most important features of regression analysis in a preset order and continues to reanalyze results until an optimum set of parameters or coefficients is found. In Chapter 21, the selection and the testing of individual parameters within a trading strategy are discussed. This involves approximating their initial value and identifying a test range. An ARIMA model does all of this as part of its special process because it is used to recalculate the best fit each time a new piece of data appears. It may be thought of as an adaptive process. G.E.P. Box and G.M. Jenkins refined ARIMA at the University of Wisconsin, and their procedures for solution have become the industry standard. This technique is often referred to as the Box-Jenkins forecast. The two important terms in ARIMA are autoregression and moving average. Autoregression refers to the use of the same data to self-predict, for example, using only gold prices to arrive at a gold price forecast. Moving average refers to the normal concept of a smoothing price fluctuations using rolling averages of the past n days. The moving averages and the popular variations are discussed thoroughly in chapters 7 and 8. This process uses an exponential smoothing technique, which is convenient for computation. In the ARIMA process, the autocorrelation is used to determine to what extent past prices will forecast the future prices. In a first-order autocorrelation, only the prices on the previous day are used to determine the forecast. This would be expressed as Pt equals to 8 times Pt minus 1 plus E, where Pt equals to the price being forecast as a dependent variable, and Pt minus 1 equals to the price being used to forecast the independent variable, and A equals to the coefficient, which is constant factor, and E is the forecast error. In a second-order autoregression, the previous two prices are used. That is, Pt equals to A1 times Pt minus 1 plus A2 times Pt minus 2 plus E. Again, is the error. And where the current forecast Pt is based on the two previous prices Pt minus 1 and Pt minus 2. There are two unique coefficients and the forecast error. The moving average is used to correct for the forecast error E. There is also the choice of the first and the second order moving average process. First order equals to Et equals to capital Et equals to little et minus b times little et minus 1. Second order is capital Et equals to et minus little et minus b1 times little et minus 1 minus bt times little et minus 2, where capital Et is the approximate to the error term, and the little et is the total today's forecast error. And little et minus 1 and little et minus 2 are the two previous forecast errors. Little b1 and little b2 are the two regression coefficients. Because the two constant coefficients b1 and b2 can be considered percentages, the moving average process is similar to exponential smoothing. Now, the success of the ARIMA model is determined by two factors: high correlation in the autoregression and low variance in the final forecast errors. The determination of whether to use a first or second order autoregression is based on a comparison of the correlation coefficients of the two regressions. If there is little improvement using the second order process, it is not used. The final forecast is constructed by adding the moving average term, which approximates the errors back into the autoregressive process. That is, Pt prime equals to Pt plus capital Et plus E prime, where Pt prime is the new forecast and E prime is the new forecast error. The moving average process is again repeated for the new errors E prime, added back into the forecast to get a new value P prime prime and another error E prime prime. When the variance of the errors becomes sufficiently small, the ARIMA process is complete. The contribution of Box and Jenkins was to stress the simplicity of the solution. They determined that the autoregression and the moving average steps could be limited to first or second order processes. To do this, it was first necessary to detrend the data, thereby making it stationary. Detrending can be accomplished most easily by differentiating the data, creating a new series by subtracting each previous term Pt minus 1 from the term Pt. Of course, the ARIMA program must remember all of these changes or transformations in order to restore the final forecast to the proper price notation by applying these operations in reverse. If a satisfactory solution is not found in the Box-Jenkins process, it is usually because the data are still not stationary and further differentiating is necessary. With the three features just discussed, the Box-Jenkins forecast is usually shown as ARIMA of a PDQ, where P is the number of autoregressive terms, D is the number of differences, and Q is the number of moving average terms. The expression ARIMA 011 is equivalent to simple exponential smoothing, a common technique discussed in the next chapter. In its normal form, the Box-Jenkins ARIMA process performs the following steps. 1. Specification. Preliminary steps for determining the order of the autoregression and the moving average to be used. The variances must be specialized. In many price series, increased volatility is directly related to increased price. In stocks, the common assumption is that the relationship is log normal, that increasing volatility takes the shape of a logarithmic curve. A simple test for variance stability using the log function is checked before more complex transformations are used. Prices are detrended. This uses the techniques of a first differences. However, a second differences or more will be performed if it helps us to remove further trending properties. In a series, this is determined by later steps. Specify the order of the autoregressive and moving average components. This fixes the number of prior turns to be used in these approximations, not necessarily the same number. In the Box-Jenkins approach, these numbers should be as small as possible. Often one value is used for both. Large numbers require rapidly expanding amounts of calculation, even for a computer. The number of turns is a critical part of the ARIMA solution. The object of this last step is to find the fewest terms necessary to solve the problem. All ARIMA programs will print a correlogram, a display of the autocorrelation coefficients. The correlogram is used to find whether all the trends and well-defined periodic movements have been removed from the series by differencing. Figure 6.13 shows the output from a prostat for 15 legs using the first differences of the 20 years of gold futures price. If any of the correlations had been significant, for example over 0.40, the data would be different again. The correlogram is one way of visualizing series correlation. The dependence of current data on previous data. This same objective will be accomplished differently using a Monte Carlo process to estimate investment risk, discussed in Chapter 23. To estimation determining coefficients, the previous steps was used to reduce the number of autoregressive and moving average terms necessary to the estimation process. The ARIMA method of solution is one of minimizing the errors in the forecast. In minimization, it will perform a linear or nonlinear regression on price, depending on the number of coefficients selected, determine the errors in the estimation, and then approximate those errors using a moving average. It will next look at the resulting new error series, attempt to estimate and correct the errors in that one, and repeat the process until it cannot improve results further. To determine when an ARIMA process is completed, 3 tests are performed at the end of each estimation process. 1. Compare the change in the coefficient value. If the last estimation has caused little or no change in the values of the coefficients, the model has successfully converged to a solution. To compare the sum of the squares of the error, if the error value is small or if it stays relatively unchanged, the process is completed. 3. Perform a set number of estimations. Unless a maximum number of estimations is set, an ARIMA process might continue indefinitely. This safety check is necessary in the event the model is not converging to a solution. Once completed, the errors can be examined using an O statistic to check for any trend. If one exists, an additional moving average term may be used to eliminate it. Forecast results. Once the coefficients have been determined, they are used to calculate the forecast value. These forecasts are most accurate for the next day and should be used with less confidence for subsequent days. See Figure 6.14. What if the forecast does not work? First, the process should be checked to be certain that it was performed properly. Be sure that any data transformations were reversed. Pay particular attention to the removal of trends using the correlogram. Next, check the data used in the process. If the data sample is changing, which can be observed on the price chart, select either a shorter or longer period that contains more homogeneous data, that is, data similar to the current market period. ARIMA trading strategies. In the article that originally piqued the interests of traders, Anon uses a 5-day ahead forecast. If the ARIMA process forecasts an uptrend and the prices fall below the forecast value, the market can be bought with added confidence, expecting lower risk and more profit by buying at a price that is below estimated value. This technique of selecting better entry points may compensate for some of the inaccuracies latent in any forecasting method. The danger of this approach is that prices may continue to move counter to the forecast. Following the trend, use the 1-day ahead forecast to determine the trend position. Hold a long position if the forecast is for higher prices, and take a short position if the process is expecting lower prices. Mean reversing indicator using the ARIMA confidence bands to determine oversold levels. Not only can a long position be entered when prices penetrate the lowest 95% confidence band, but they can be closed out when they return to the normal 50% level. Although mean reversion trades are tempting, they always carry more risk than trend trading. A conservative trader will enter the market only in the direction of the ARIMA trend forecast. As shown in the forecast 6.14, if the trend is up, only the penetrations of a lower confidence band will be used to enter new long positions. Use of highs and lows. The implied highs and lows as well as the independently forecasted highs and lows can be the basis for other interesting strategies. The following two are used with intraday prices. 1. Using confidence bands based on the closing prices by an intraday penetration of the expected high or sell short penetration of the expected low and liquidate the position on the close. Use a stop loss. Take positions only in the direction of the ARIMA trend. 2. Using the separate ARIMA models based on the daily high and low prices by a penetration of the 50% level of the high and sell penetrations of the 50% level of the lows. Liquidate positions on the close. Use a stop loss. Slope. The 1-day ahead forecast suggested in the following the trend a few paragraphs earlier is essentially objection of the slope of the trend line. The purpose of a directional analysis, whether regression or moving averages, is to uncover the true direction of prices by discounting the noise. Therefore, the slope of the trend line or the direction of the regression forecast is the logical answer. The popular alternate for triggering a new directional signal is the price penetration of an envelope or band value. Using regression analysis, that band can be replaced by a confidence level. While it is true that the number of random or false penetrations declines as the confidence band gets farther away from the trend line, so does the total number of penetrations. At any band distance, there are still a large number of erroneous signals. The slope itself should be viewed as the best approximation of direction. Common filters. Common offers an alternative approach to ARIMA, allowing an underlying forecasting model, message model, to be combined with other timely information observation model. The message model may be any trading strategy, moving average, or regression approach. The observation model may be the specialists or floor brokers' opening costs, market liquidity, or earlier trading activity in the same stock or index market on a foreign exchange, all of which have been determined to good candidate inputs for forecasting. Assume that the original forecast message model can be described as follows. M of PT equals to CF times PT minus 1 plus M times ET. And the observation model is big O of PT equals to C0 times PT plus little o times ET, where ME and OE are the message and M times E and O times E are the message and observation model errors respectively. Now the combined forecast would then use the observational model error to modify the results. That is PT plus 1 prime equals to CF times PT prime plus KT plus 1 times O times ET, where K is the Kalman gain coefficient, a factor that adjusts the error term. Basic trading signals using a linear regression model. A linear regression or straight line fit could be the basis for a simple trading strategy similar to a moving average. For example, an end linear regression applied to the closing prices can produce a one-day ahead forecast price, ft plus 1, a projection of the slope. We can use this with the following rules for trading. Buy when tomorrow's closing price, ct plus 1, moves above the forecasted value of tomorrow's close, ft plus 1. And sell short when tomorrow's closing price, ct plus 1, moves below the forecasted value of tomorrow's close, ft plus 1. Adding confidence bands. Because the linear regression line passes through the center of price movement during a steady period of rising or falling prices, these rules would produce a lot of buy and sell signals. To reduce the frequency of signals and avoid changes of direction due to market noise, confidence bands are drawn on either side of the regression line. 90% confidence band is simply 1.65 times the standard deviation of the residuals. So that is RT, the difference between the actual price and the corresponding value on the regression line as of time t, the most recent price. A 95% confidence band uses a multiplying of 1.96. However, most people use 2.0 simply for convenience. The new trading rules using a 95% confidence band would then become buy when tomorrow's closing price ct plus 1 moves above the forecasted value of tomorrow's close, ft plus 1 plus 2 times RT. Sell short when tomorrow's closing price ct plus 1 moves below the forecasted values of tomorrow's close, ft plus 1 minus 2 times RT. An important difference between a model based on linear regression and one founded on a moving average is the lag. Both methods assume that prices will continue to move according to the pattern identified using the last price data available. If prices continue higher at the same rate, a moving average system will initially lag behind, then increase at the same rate. The lag creates a safety zone to absorb some minor changes in the direction of prices without indicating that the trend has changed. See Chapter 7 for a complete discussion of moving averages and Chapter 8 for a comparison of a linear regression slope trading system with the 5 other popular trending tools. A regression model, however, identifies a change of direction sooner by measuring tomorrow's actual price against the projected future prices. A straight line projections for linear regression. Confidence bands around the straight line projection will decide the size of the price move up or down needed to change the trend direction. Figure 6.15 shows the changing direction of a really linear regression at 3 points in time computed to a moving average. At the most recent period on the chart, the reversal point for the trend direction is much closer using the confidence bands of the regression than the lagged moving average. This may not be the case during the intervals where price changes direction at the bottom of the chart. The website has a spreadsheet bond regression with bands that produces trading signals and performance using regression bands. It also compares the results with the slope methods described in the next section. In general, the use of regression lines works well for finding the price trend, although actual trading signals differ from moving average and breakout strategies. As with most trending systems, performance tends to improve as the calculation period increases, capturing the largest economic trends. Using the linear regression slope. The slope of the linear regression line, the angle at which it is rising or falling, is an effective way to simplify the usefulness of the regression process. The slope shows how quickly prices are expected to change over a unit of time. The unit of time is the same as the period of data used to find the regression values. When you use a longer calculation period, the slope of the regression line changes slowly. When you use only a few days in your calculation, the slope changes quickly. Using only the slope, you can trade with the following rules. Buy when the value of the slope is positive, rising. Sell when the value of the slope is negative, falling. When using the slope, there is less need for a confidence band because the longer calculation period smooths out erratic price movement. The scale of the slope is different from the prices. Therefore, it will be seen in a separate panel on the chart, the middle panel in figure 6.16. The linear regression slope will be compared to the other trending techniques in chapter 8 and its performance is competitive. Adding correlations. The slope is a practical substitution for the regression line and the confidence bands, but it can also be misleading. It is possible to have the same slope value while prices are moving higher in both a smooth pattern or in a very noisy, erratic one. Using the correlation coefficients R2 will provide a measurement of the consistency of the price movement. Instead of R2, which is always positive, R will be used, and instead of using the usual price differences or return differences, the actual prices will be used and correlated against a series of sequential numbers. This should give us a better value for whether the prices are trending. If R becomes negative, then prices are trending down. This can be seen in the bottom panel of figure 6.16. A 60-day moving average of prices is shown at the top. A corresponding 60-day slope is in the middle and a 6-day R at the bottom, along with a 30-day R period over 2/2 trend of R. The trading rules for the slope are normally the same as those for a moving average. A long position is entered when the trend line or slope turns up and a short sale begins when the trend line turns down. However, the slope today can be less than yesterday but still positive, which means that the trend is still up. Then another rule would be to buy when the slope turns positive and sell short when it turns negative. Figure 6.16 shows that using the moving average trend is good, but has the greatest lag. The slope is much faster but less stable. Adding R gives a difference value of where the trend change and it can complement either method. Forecast oscillator. Tashka Chandy used the regression forecast and its residuals to create a trend following signals called a forecast oscillator. Using a 5-day regression, find the residuals and calculate the percentage variation from the regression line. A buy signal occurs when the 3-day average of the residuals crosses above the regression line. A short sale is when the 3-day average of the residuals crosses below the regression line. If percentage of ft equals to 100 times yt minus yt hat divided by yt, and the percentage ft of 3 is a 3-day moving average of the percentage f. Then, buy when percentage ft of 3 crosses above yt hat. Sell short when percentage ft of 3 crosses below yt hat. This makes the assumption that the residuals have a trending quality. Measuring market strength. One of the natural applications of the linear regression is to measure and compare the strength of the one market against another. For example, we might want to ask which market is leading the other, Hewlett Packard or Dell. The slope of the linear regression, measured over the same calculation period, is the perfect tool for comparing or ranking a set of markets. Figure 6.17 shows the prices of 4 pharmaceutical companies: Amgen, AMGN, Johnson & Johnson, J&J, Merck, MRK, and Pfizer, PFE. Which of them is the strongest during the last 60 days? No doubt it's PFE. The line at the bottom, but the weakest is not as clear. In order to rank these correctly, it is best to index the stock prices starting at 100 on the same date. For one only stocks, index is not necessary. But if you are mixing stocks and futures or just using futures, indexing will be needed to put the trading units into the same notation. Figure 6.18 shows the indexes the stocks begin at the value of 100. Once indexed, that apply a rolling linear regression slope to each market using the same calculation period, 60 days in this example. Figure 6.19 shows that PFE was the most volatile because the slope varied from much higher to much lower than the others, but each stock had its turn at being The strongest and weakest at the right side of the chart, PFE finishes the strongest, followed by AMGN, MRK, and JNJ. In Chapter 13, this technique will be used to create the classic market-neutral technology. The basis of the strategy is to either buy the strongest stock and sell short the weakest, or sell short the strongest and buy the weakest. In either case, strongest and weakest are determined by the slope of the regression rather than a moving average trend.